And before I start reading, let me wish you a Merry Christmas, Happy New Year, because we are not going to get together until next year. Ladies and gentlemen, Vice President and I are very pleased to welcome you to our press conference. We'll now report on the outcome of today's meeting of the Governing Council, which was also attended by the Commission Vice President, Mr. Rehn. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged, owing to high energy prices and increases in indirect taxes in some euro area countries. HICP inflation rates have been elevated for some time. More recently, they have declined as anticipated and are expected to fall below 2% in 2013. Over the policy-relevant horizon, inflation rates should remain in line with price stability. The underlying pace of monetary expansion continues to be subdued. Inflation expectations for the euro area remain firmly anchored in line with our aim of maintaining inflation rates below but close to 2% over the medium term. The economic weakness in the euro area is expected to extend into next year. In particular, necessary balance sheet adjustments in financial and non-financial sectors and persistent uncertainty will continue to weigh on economic activity. Later, in 2013, economic activity should gradually recover as global demand strengthens and our accommodative monetary policy stance and significantly improved financial market confidence work their way through the economy. In order to sustain confidence, it is essential for governments to reduce further both fiscal and structural imbalances and to proceed with financial sector restructuring. Today, we have also decided to continue conducting our main refinancing operations, MROs, as fixed-rate tender procedures with full allotment for as long as necessary, and at least until the end of the sixth maintenance period of 2013 on July 9th, 2013. This procedure will also remain in use for the Eurosystem special term refinancing operations with a maturity of one maintenance period, which will continue to be conducted for as long as needed, and at least until the end of the second quarter of 2013. The fixed rate in these special term refinancing operations will be the same as the MRO rate prevailing at the time. The rates in the 3-month longer-term refinancing operations to be allotted until June 2013 will be fixed at the average rate of the MROs over the life of the respective longer-term refinancing operations. Let me now explain our assessment in greater detail, starting with the economic analysis. Following a contraction of 0.2% quarter-on-quarter, in the second quarter of 2012, euro area real GDP declined by 0.1% in the third quarter. Available statistics and survey indicators continue to signal further weakness in activity in the last quarter of this year, although more recently, some indicators have stabilized at low levels and financial market confidence has improved further. Over the shorter term, weak activity is expected to extend into next year, reflecting the adverse impact on domestic expenditure of weak consumer and investor sentiment and subdued foreign demand. A gradual recovery should start later in 2013 as our accommodative monetary policy stance and significant improvement in financial market confidence work their way through to private domestic expenditure and a strengthening of foreign demand should also support export growth. This assessment is reflected in the December 2012 Eurosystem staff macroeconomic projections for the euro area, which foresee annual real GDP growth in a range between minus 0.6% and minus 0.4% for 2012, between minus 0.9% and 0.3% for 2013, and between 0.2% and 2.2% for 2014. Compared with the September 2012 ECB staff macroeconomic projections, the ranges for 2012 and 2013 have been revised downwards. The Governing Council continues to see downside risks to the economic outlook for the euro area. These are mainly related to uncertainties about the resolution of sovereign debt and governance issues in the euro area, geopolitical issues, and fiscal policy decisions in the United States, possibly dampening sentiment for longer than currently assumed, and delaying further the recovery of private investment, employment, and consumption. According to Eurostat's flash estimate, euro area annual HICP inflation fell to 2.2% in November 2012, down from 2.5% in October and from 2.6% in the 2 previous months. On the basis of current futures prices for oil, inflation rates are expected to decline further to below 2% next year. Over the policy-relevant horizon, in an environment of weak economic activity in the euro area and well-anchored long-term inflation expectations, underlying price pressures should remain moderate. This assessment is also reflected in the December 2012 Eurosystem staff macroeconomic projections for the euro area, which foresee annual HICP inflation of 2.5% for 2012, between 1.1% and 2.1% for 2013, and between 0.6% and 2.2% for 2014. Compared with the September 2012 ECB staff macroeconomic projections, the projection range for 2013 has been revised downwards. In the Governing Council's assessment, risks to the outlook for price developments are seen as broadly balanced, with downside risks stemming from weaker economic activity and upside risks relating to higher administered prices and indirect taxes, as well as higher oil prices. Turning to the monetary analysis, the underlying pace of monetary expansion continues to be subdued, taking into account developments over several months. Most recently, the annual growth rate of M3 increased to 3.9% in October from 2.6% in September, while M1 growth accelerated to 6.4% from 5% over the same period. These developments are partly due to a specific transaction leading to an increase in overnight deposits belonging to the non-monetary financial sector. At the same time, deposits from households and non-financial corporations also rose in October. Overall, more observations are needed to distinguish between shorter-term volatility and more lasting factors. Unlike in the case of monetary developments, there has been little change in credit growth. The annual growth rate of loans to the private sector remained at minus 0.4% in October, unchanged from September. But this development reflects further net redemptions in loans to non-financial corporations, which led to an annual rate of decline in these loans of minus 1.5%, down from minus 1.2% in September. The annual growth in MFI lending to households remained unchanged at plus 0.8% in October. To a large extent, subdued loan dynamics reflect the weak outlook for GDP, heightened risk aversion, and the ongoing adjustment in the balance sheets of households and enterprises, all of which weigh on credit demand. Furthermore, in a number of euro area countries, capital constraints, risk perception, and the segmentation of financial markets restrict credit supply. In order to ensure an adequate transmission of monetary policy to the financing conditions in euro area countries, it is essential to continue strengthening the resilience of banks where needed. The soundness of banks' balance sheets will be a key factor in facilitating both an appropriate provision of credit to the economy and the normalization of all funding channels. Decisive steps for establishing an integrated financial framework will help to accomplish this objective. A single supervisory mechanism is one of the main building blocks. It's crucial move forward towards reintegrating the banking system. It is a crucial move towards reintegrating the banking system. To sum up, the economic analysis indicates that price developments should remain in line with price stability over the medium term, and a cross-check with the signals from the monetary analysis confirms this picture. Further economic policy measures and progress in the reform of European governance should help to support financial market sentiment and improve the outlook for economic growth. In this context, the Governing Council looks forward to the roadmap towards genuine economic and monetary union to be decided at the European Council meeting on 13-14 December 2012. Initiatives to accelerate structural reforms that help restore competitiveness are particularly important to revive the growth potential of euro area countries and to increase employment. More generally, all euro area countries must ensure that their product and labor markets possess the adjustment capacity required for their smooth and effective functioning within a monetary union. Finally, continued fiscal consolidation is expected to restore sound fiscal positions in line with the commitments under the Stability and Growth Pact and the 2012 European Semester recommendations. Significant progress has already been made in reducing domestic and external imbalances and improving competitiveness. Continued policy actions on the European structural and fiscal reform fronts should be mutually reinforcing and send a strong signal to markets. And we are now at your disposal for questions.
Okay, let's start by the block in the middle, the second row, please.
Marica De Feo, Corriere della Sera. Mr. President, is Italy precipitating into an abyss? This is a question which markets are asking. And which signal do you think is necessary, given the fact that the spread between Italian BTP and Bund went up again to 330 basis points? Which signal is necessary for the markets to ensure that Italy is going forward?
I'm sorry, but I will not comment on the specific Italian situation. Thank you.
Okay, your neighbor, please, second row.
Hakon Redder from Børsen of Copenhagen. In the context of what you just said about you looking forward to what's coming out of the Council next week and the roadmap, in the first draft for the conclusions for that summit, it's more or less only said that that will be taken up again after 2014 when we have a new parliament and we have a new commission.
I'm sorry, what will be taken on?
The roadmap for the full monetary union. It's only mentioned very, very shortly in the first draft. Will it be a disappointment for you if the Council doesn't agree upon a full roadmap with dates?
Well, I expect this is going to be an important Council. It is an important Council because it will basically say that the commitments and the engagements and the promises being made in the June summit are either maintained or are going to be maintained in years to come. And I don't have such a poor expectation as you hinted at. Actually, I'm confident that the determination of the June summit will be confirmed in the oncoming summit.
Your neighbor again, Joanna.
Joanna Trieg with M&I. Mr. Draghi, you've warned repeatedly, or you've said repeatedly that significantly higher credit costs for companies in the periphery are unjustified. And I'm wondering whether there might be anything you would be able to do to address this problem more directly, especially should there never be an activation of the OMT. And my second question is, did you discuss interest rate cuts today? And in relation to that, in your view, what are the biggest downside risks associated with a negative deposit rate in the Eurozone? Thank you very much.
Okay, so it's 3 questions. Well, actually, I haven't said that higher credit costs are unjustified. I said that, in a sense, it's quite natural that you have different credit costs in different parts of the monetary union, reflecting the different degree of risk. But there is an extent, there is a range beyond which I said there are risks like redenomination risks, which make these differences unacceptable. And so your question was, what have we done about that?
No, my question is there anything that you could be doing to address this more directly?
We have, I think since the Governing Council has decided about the OMT in early August, we have seen a very significant improvement in financing conditions and a narrowing down of these differences between interest rates and lending costs in different parts of the Union. So from this point of view, through that announcement, the Governing Council has acted promptly to address this situation. Did we discuss interest rate cuts? That was the second question. There was a wide discussion, but in the end, the prevailing consensus was to leave the rates unchanged. On the negative interest rates on the deposit facility, nothing, there are no news there. As Mr. Pratt has said, we are operationally ready, but the discussion didn't go into any depth with respect to this point. We briefly touched upon the complexities that such measure would involve and possible unintended consequence, but we didn't elaborate any further. Thank you.
Okay, the third row, please. Yeah.
Eva Kühnen from Reuters. Mr. Draghi, are you concerned about the recent disagreement about the supervisory mechanism for banks, and what implication could this have for this plan? A possible delay, maybe. And my second question would be, did you discuss today the possibility of national central banks rolling over the Greek debt that they hold in their investment portfolios? Thank you.
Thank you. I think we have to look at these discussions on the SSM in perspective. If you think before the summer we didn't even have an idea of what this could look like. The Commission did a very good work, in producing a draft regulation, which is really deserves a lot of credit. But the political discussion has really just started. So I look at this in perspective. I'm very confident we'll reach an agreement. There is a generalized will to reach an agreement. The benefits of having one single supervisor for the euro area are not disputed. Its main aim is to break the link between the sovereigns and the banks. It's to make banks basically reliable, trustworthy, regardless of the place where they have their headquarters and where they exercise their business. So that's why it's so important, and the benefits aren't disputed. I think it's just a normal part of the discussion. But as I said, I'm quite confident that we will soon have an agreement. On the NCBs, we didn't really have a deep discussion about that. We certainly discussed about this, and we basically haven't reached a conclusion yet. Thank you.
Okay, let's go to the fourth row. Yes, just next to you. Yeah. No, just here. Behind, yes.
Yeah, it's Reinhard Hönighaus. Last question from FD Deutschland, also on the banking union. Would you actually favor a treaty change to come to in parallel to establishing the SSM under the 127.6, and then work on a treaty change in parallel to work on a more solid basis that you can have an easier distinction between the monetary policy functions and the supervision? Thank you.
Well, I think we have to understand, all of us, that the ECB here, it's not a legislator. It's a passive subject to some extent. So it's not up to us to decide what's the best legal route to proceed. The legal counsel of the European Council and all the other, I don't know, thousands of lawyers that have been asked to pronounce on this issue considered 127.6, I believe, an adequate basis for building a single supervisor mechanism in the euro area. So I frankly am not in a good position to dispute this this conclusion. It's also very important, however, let me say this, that we have a legal basis in place. If it is the ECB which is going to carry out this task, it's absolutely essential for the ECB to have a legal basis in place to do the next step of the work, which is basically to build this mechanism. And so we are looking forward to having that in place, because otherwise, of course, also our preparation will be slowing down.
Thank you. Your two neighbors, and then we change the block.
Brian Blackstone with the Wall Street Journal. Your economic outlook for next year, after this year, is quite weak. Are there any tools outside of interest rates that the ECB could deploy if conditions were to erode further, and what types of things could trigger more aggressive ECB action to safeguard the economy? And my second question is on Greece. There was this debt buyback that was launched. The private sector's been asked for a second time to take a haircut on their Greek bonds. The ECB has ruled itself out for that. The IMF has ruled itself out for that. The governments don't want to do it. Are the Eurozone institutions going to the private sector too much on Greece, especially given that Greek bondholders purchased these bonds thinking that the statistics were right coming out of Greece, thinking that the governance of the Eurozone was going to prevent the kind of crisis that we've seen? Thank you.
Thank you. You see, we, as you said rightly so, the economic outlook is weak. At the same time, we haven't seen any substantive change in our medium-term assessment of price stability. Also, we consider that the monetary conditions remain accommodative. Especially after our OMT announcement, the improvement in financial markets has been significant, both in bonds, the bond markets, but also in the stock markets. So you see a fairly, I would say, a fairly good performance of the stock markets in line of an oncoming weak economic outlook. So I think one should keep all these elements in mind. Also, if you look at some expectations data, you also see that of recent in Germany, The IFO Business Climate Index increased in November after 6 consecutive months of decline. In France, the ANSEE Industrial Business Confidence Index increased in November, but both of them remain below their long-term averages, of course. And also in Italy, the Istat Business Confidence of the manufacturing sector improved in November more than expected. So you have these conflicting signs, in a sense. Some of them point downward, others point upward. And we will continue monitoring the situation, of course, and we'll take our decisions. On Greece, now you're saying that were you saying that too much is being asked from the private sector? My impression is actually the opposite. A lot's been asked from the public sector. And mostly, I would say, this whole program is being financed and really put forward by the public sector with public sector money. So the debt buyback is part of this, and it's early to say how it is going. But basically, I would say that it's mostly public sector involvement in terms of new money, in terms of also. What is most important of this latest agreement is the medium-term commitment to possibly provide new money in case Greece were to have a primary surplus, but somehow things were not going, not because of Greece's lacking of compliance with the program. So this is quite important. That's the first time it's been done, actually.
Your neighbor, please. Yeah.
Yeah, Franz Busch, Zweites Deutsches Fernsehen. Mr. President, I have 2 questions about your membership in the Group of 30. First, taking your closeness to the private banks and in face of pending conflict of interest and ethical issues, how do you explain your ongoing G30 membership? And my second, of the 30 members, 5 members are former or present bankers of Goldman Sachs. This group is co-funded by Goldman Sachs. You are a former fellow of Goldman Sachs. How do you intend to avoid conflicts of interest?
Well, actually, I don't intend to avoid. I think there aren't any conflict of interest. But let me, I'll read it to you what is given the objectives and purpose of the organization, the ECB does not consider that membership of the ECB's president in the Group of 30 entails a conflict of interest. You might have seen that I'm not the only central banker being member of the Group of 30. Just to name a few of my predecessors, Jean-Claude Trichet, Mervyn King, who were not Goldman Sachs bankers, Governor Zhu of China, who was not a Goldman Sachs member, Masaki Shirakawa, who was not a Goldman Sachs member, and also Mark Carney, who was a Goldman Sachs member. I have no idea whether the Group of 30 is being financed by Goldman Sachs. It's new to me. But the European Ombudsman was approached by the person claiming that it is a conflict of interest. The ECB has replied to the questions of the European Ombudsman by the given deadline, and the answer is publicly available. The final assessment of the European Ombudsman is still pending. Thank you.
Block number 1, second row, please.
Sylvia Wadwa, CNBC. 2 questions. One on the money being passed through or not being passed through from the banking sector to the real economy. Are you more satisfied now with how money ends up in the so-called real economy? Have you got any findings how, for example, the LTROs not only helped refinance the banking industry, but also ended up somewhere in industry, etc.? And the second one,
in terms of what we've seen in the latest movements in M3 or in specifically M1, you said it's a bit early to say whether this is just an uptick, a month-on-month uptick. Have you got any further findings or any further clues whether, especially when you see an uptick in M1, there is actually a precursor to an uptick in consumer demand that then might filter through to the economy? Thank you.
Well, with respect to the first question, our LTRO and our refinancing facilities have injected indeed a very significant amount of liquidity, but this liquidity didn't actually reach the real economy to a large extent. They basically, especially the LTRO, avoided major disasters, which were looming ahead of the funding crunch that was characterized in the first quarter of this year. As I've told you many times, there were about 230, 260 billion euros of bank bonds coming due, to which you will have to sum something like 300 and plus billions of sovereign bonds coming due, all in the first quarter. So, to some extent, the credit crunch that had started last year, because of the fear of the funding crunch that would take place in the first quarter of this year, was halted by that action. But this action addressed really the funding needs. And as you know, banks may not lend to the economy because of funding problems, and they have been addressed, because of capital shortages. And also, to some extent, they have been addressed by the banks themselves because a significant amount of capital is being raised in the last 2 years. But also there is a risk perception issue. And the risk perception that comes from the deteriorating quality of your counterparty, and that cannot be addressed by the funding facilities. So the bottom line of this is that we think there is also another problem now, that credit is subdued, credit growth is subdued mostly because of demand factor. In this context, we really continue thinking about this. We know we have to overcome, first and foremost, fragmentation of the financial and credit markets in the euro area. But as I said at the beginning, the currently accommodative monetary policy stance will find its way through the economy, and we view that by the second part of the next year we should see the beginning of a recovery. The uptick in the monetary policy aggregates depend only on one thing. The ESM paid their tranche, and that increased the monetary aggregates by something like 30, if I'm not mistaken, 30 billion euros, and that is what's being registered by this figure.
Thank you. The third row. Next question.
Magna Pop from the EU Observer. I'm here, Mr. Draghi. My question comes back to the single supervisory mechanism. At the core of the disagreement, or why there hasn't been an agreement yet, is precisely that Germany feels this mechanism shouldn't be covering all Eurozone banks, but just the big ones. So what exactly can you tell them, or what kind of compromise agreement do you see possible to move the debate further? Thank you.
Thank you. One should aim at having this mechanism covering all euro area banks from a legal jurisdictional viewpoint, because you want to avoid fragmentation in the banking market. You want to keep a level playing field. You want to avoid stigma for some banks categories. But then, in practice, I don't think there is going to be much difference between this position and what's been advocated by others. In practice, it's quite obvious that the ECB supervisor will not be able to supervise 6,000 banks. And in practice, it's obvious that as the size of the bank and as its systemic significance decreases, so it will decrease the intensity of the supervision that's being carried out at central level, and it will increase the intensity of the supervision that's being carried out at national level.
Thank you. Your neighbor, please.
Good afternoon. Jérémy Marais for l'AGFI. The Greek economy is still shrinking despite all the public money that, as you just said, has been lent to it. How much time do you need to recognize that the killer medicines that you gave to the Greek people are not working? Thank you.
Well, I mean, I wouldn't agree with the killer medicine, especially given the fact that the ECB is the largest creditor to Greece. So just keep in mind what the ECB and the Governing Council has done. Second, I acknowledge the significant progress that the Greek governments, many governments, but especially this last one, have done in Greece. I acknowledge a very significant progress in undertaking both fiscal consolidation and structural reforms. And that's very important. Part of this is part of what's happening is a needed adjustment. Let's not forget that the imbalances from which the Greek economic policy was starting were really very, very important. Thank you.
Let's go to block 3, please. Second and third row. Yeah.
Can you hear me? Stefan Weicker with Bloomberg News. First question on Spain. Vice President Constancio recently said that the ECB expects Spain to apply for aid soon to activate the OMT. When do you expect that application, and what if Spain remains hesitant to do so? Second question on Italy again, not politically, but from a monetary policy point of view. Is the ECB ready to activate the OMT on Italy as well, if necessary? Thank you.
Well, let me answer telling you what Mr. Constancio meant. I think we all said all the times that we would not tell governments what to do. So it's up to the governments what to do. They know what the conditions are. They know they will have to have in place an ESM agreement, a macro adjustment program, precautionary or different. So they know what the conditions are. And this is going to be a necessary but not sufficient condition. And then the ECB will carry out its independent assessment. And so this holds both for Spain and for any other country, really. Thank you. Italy as well. All countries, yes, sure. And that's what that's in the statement we made. That's communication. That's what we always said. So it's a combination of conditionality and support. But the support doesn't come automatically.
Your neighbor and then the third row.
Faisal Islam from Channel 4 News. Unemployment has reached a record high in the Eurozone. What's your response to obviously the army of unemployed and youth unemployed now in the Eurozone? And is it a price worth paying for the sorts of structural adjustments that you think are necessary to make the Euro work?
Well, it's hard to say whether it's a price worth paying. I mean, I think this question should be addressed to the policymakers which had created this situation to begin with. Let's not forget that we are in this situation which I term to be a bad equilibrium, also because of the poor policymaking or the lack of policymaking during the years before the crisis. The crisis has simply highlighted disequilibria which were already existing there. The crisis highlighted that our banks were not properly capitalized. The crisis highlighted that our budgetary and debt positions of our governments were not sustainable. And the crisis highlighted also that our euro area governance ought to be vastly improved. So what's happening now is the direct outcome of the policy decisions that have been enforced in order to respond to these disequilibria, which were unsustainable. I agree with you, it's a very hard price, but it's unavoidable. And the only way, I think, to mitigate the impact of this budgetary consolidation, which is contractionary in the short term, I've always said that, is to undertake structural reforms that could increase competitiveness, increase exports, create jobs and growth. Thank you.
Thank you. The third row, please.
Michael Steen, Financial Times. Mr. Draghi, these are some fairly dramatic downward revisions in your own staff's growth projections for 2013. Can you just explain again why are you apparently going with the sort of more optimistic reading of the business surveys in terms of not going for another rate cut and ignoring your own staff projections to an extent? And the second question on banking union, as a passive subject, as you said, what is the sort of minimum that you would set as a standard that is required for this to make sense? If there's a political decision that this is not going to affect all 6,000 banks, would you as the ECB turn around and say, well, that's pointless, there's no point doing this then? Thank you.
On the first question, you know, in a sense, I already responded to the first question when I said that the outlook for the medium-term price stability hasn't changed substantially. And also, I highlighted some positive elements of the present situation, the improvement in financial markets especially, the stock markets, the bond markets. And I also highlighted the already very accommodative monetary policy stance. If you think from July to today, some countries' spreads or some countries' sovereign bond yields went down by 200, 250 basis points. That's much more than anything you can achieve by a reduction in the short-term policy rate. So, to some extent, we will continue looking at the situation, of course, but to some extent, we have already done much that is needed. I'm not going to say that. I'm not going to answer to this question, as you can imagine. But basically, that gives you, I think, the picture of the situation where the Governing Council met today. On the second point, I think in the very first press conference I had about the banking union, I said that the creation of a single supervisor, especially if it's the ECB is going to be tasked with this, should basically create a strong supervisor, should create a supervisor where the ECB wouldn't have the reputational risks that often come together with supervision. So it's got to be a serious thing. And so that is it should create or contribute to create a level playing field. But especially from the ECB viewpoint, that's what we really care, that we are placed in a situation where our primary task, which is monetary policy geared to deliver price stability in the medium term, is not going to be mixed by other considerations. So, for example, we are very much in favor of separation between monetary policy and supervision. And I would say a deep thinking about how to construct this separation within the ECB is actually going on now.
Thank you. Block in the middle, third row. Yes, please.
Stefan Walling, Börsenzeitung. Mr. Draghi, sorry, but I think you make it a little bit easy if you just say about the SSM that it's a question for lawyers, because isn't that the core of all our problems, that there are basically three ways to go? One is to have the banking union and maybe a fiscal union and form a European federation with a common constitution and so keep the Eurozone running. And the second is go on with muddling through, giving more power to executives, more power to Eurocrats in Brussels and in Frankfurt, fiscal control by some people in Brussels nobody has elected at the end. And so we lose democratic and republican values on the one hand, we keep the euro. Okay, that's the price we have to pay maybe. And the third way is to say, to accept, okay, we want to state democracies and, and republics, and so we have to give up the euro to keep
and
this.
do nothing in the meantime. That's the third option. But I mean, the first option, I'm not sure I understood. What is the first option?
The first option or the third?
No, the first.
The first. No,
the third is do nothing. But
do nothing and give up the euro. That's the third option.
Yeah, that's exactly.
Yeah.
But the first.
I mean, if it's a choice, it's a choice at least.
Okay. I mean,
and the first is to found a federation, a European federation with a common constitution where you have a single supervisory mechanism with a president of that SSM that is responsible to a European government or to a European parliament that can hire and fire those men, because who at the end shall fire the SSM president at the end if he does a mistake? Shall that be 17 or 27 single governments that have to maybe find a common idea?
I think in a sense I've already expressed this. The ECB doesn't have a preference for one solution or another. The ECB is being asked to undertake this task, and if it's decided that it should be so, it will do it at the best of its capacity. So it's up to the Council, it's up to the leaders, it's up to the finance ministers to decide. I made it clear since the very first press conference what would be the conditions for the ECB to accept this task, namely that it should be in a position to carry it out in a decisive, firm, complete and strong fashion without any reputational risk. And second, that the new tasks will not be mixed with the monetary policy task, which for us remains the primary task, delivering price stability in the medium term. The rest is really in the hands of others. It's not us.
Let's take the two last questions. Yes, please.
Thank you. Arthur Beasley from the Irish Times. I have two questions. First, what is your response to the budget unveiled yesterday by the Irish government? Second, in light of the commitments made by the Irish government and borne by the Irish people, is it reasonable or not at this point to expect that there will be an agreement to recast the Anglo-Irish Bank promissory note scheme before the next payment falls due in March, and why? Thank you.
On the first point, we certainly welcome the action by the new undertaking and presenting the new budget. Is a reaffirmation of the successful, I would say, commitment of the Irish government in restoring sound economic conditions, both fiscal but also more broadly structural conditions. On the second point, I think we kind of discussed this in the past. The ECB cannot undertake any agreement, cannot enter into any agreement that is being viewed as monetary financing and be forbidden by Article 1, 2, 3 of the treaty. So other than that, there is a plenty of goodwill. Thank you.
Thank you. The last question. Yes, the lady here. And okay. Let's go on.
Maria Vega from El Mundo. The Spanish government doesn't want to apply for the OMT because they want to be sure that if they ask for your help, the risk premium will drop to 200 points. Are you open to negotiate this possibility? And another question, please. Will the OMT by itself be enough to guarantee the market stability during next year? Thank you.
Well, I think I was asked the same question before with respect to Spain, Italy, and so on. I mean, the conditions under which the OMT is going to be activated are very straight, are pretty clear. We made them clear several times. So and they don't speak about negotiations or agreement about a certain interest rate or anything like that. So I would say, when you are asked about this, fetch the press communique of the announcement of OMT, and it does contain all the conditions that are needed to activate it. On the second question, we said that the OMT the main aim of the OMT is to remove tail risks, to overcome monetary and financial fragmentation of the euro area that would stem from redenomination risks. And we would do it in a size that would be adequate to achieve its objective. Thank you.
The very ultimate question, please go ahead.
Thank you, Enrique Cerveto from the Spanish newspaper ABC. This morning was disclosed the four presidents' report setting up the operational framework for the direct bank recapitalization through the European Stability Mechanism. Will this exclude legacy debt? And if I may, another question, why the Eurobonds has been explicitly non-mentioned in this report?
Well, I can't comment really about the report as such because it's a process. It's coming out. It's working. It can still be modified by further discussions. But I can comment on both issues you've raised, saying that it's quite important that the legacy assets is being carefully defined. In other words, we all want to know exactly what it means. That's very important for the policymakers, but also for the markets and for the banks. So when the position was taken that the new ESM could not be used to fill holes created by legacy assets which had gone sour, I think one has to define exactly what these legacy assets are. So far, it's just a name. The second thing has to be about. Your question was about Eurobonds. Here, we have to understand that originally there was a breach of trust in the euro area between countries that were basically always complying, or most of the times complying with fiscal soundness, and countries that did not do so. So now the issue is not now, in the last 2 years really, the issue was to rebuild trust. For this purpose, fiscal rules were agreed, fiscal compact was agreed, a lot of actions, the common denominator of which was to have constraints on fiscal discretion. A lot of actions that will necessarily amount to a sharing of national sovereignty in as far as budget and debt are concerned. Now, at the other end of the spectrum, you have what we call mutualization of risks. Eurobond is an example of this. And that's what I think. It's pointless to begin from a Eurobond. It's pointless to begin from a policy where if I can sort of summarize this policy, I issue and you spend, because that is not realistic. That's not realistic. That will become realistic, however, when the trust will be reestablished, when there is clear evidence that basically all countries comply with the commitments and undertake economic policies with full awareness of their consequences upon other countries. Thank you.
Thank you. Thank you very much for your attention.